Well, good afternoon and welcome to our High Rock Weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you are a regular listener, we invest our money in the exact same models as our clients. We think this is a very important highlight and defines our prudent and disciplined investing strategy. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to our clients, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and joining us on the call today are my partner and colleague, Paul Tepsich, the founder of High Rock, as well as our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit our homepage and click on the Introduction to High Rock Private Client button. While you are at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, let's start with a quick review of our themes for 2017. We think that our strategy of taking a tactical approach to investing is even more important this year because of the even greater levels of uncertainty imposed on financial markets by an onslaught of evolving factors. Inflation is a key determinant of central bank policy, and while most central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% in March and is expected to do so in June and at least one or possibly two more times after that this year. Stock prices and valuations are at 14-year highs. Excess liquidity has been driving most stock markets. But what happens when central banks start to turn off the liquidity tap? And the Trump agenda has run into political hurdles. Brexit has been initiated, and French elections have rejected populism. Meanwhile, protectionist agendas continue to raise concerns. Throw in escalating tensions with North Korea, global cyber attacks, Russian hacking, and terrorist threats, and we have quite a blend of geopolitical uncertainty. Well, part of our desire to get more tactical is the changing nature of the correlations that used to be the backbone of the old school buy and hold philosophy, both in the U.S. and in Canada. Paul, have you got any updates for us?
No, we're still in the right part of the correlation chart, as you can see in the bottom part of that chart. When it's positive or green, shaded green, that means that we can expect that bonds will provide the riskier parts of our portfolio, like stocks, with a bit of a hedge, as they normally or traditionally would. So we're still in a pretty highly negative correlation spot right now, which is what we want. We want to see that. We want to continue to see that for now.
Excellent. Thank you. When we started our private client division over 2 years ago, we wanted to add a third dimension to the standard buy and hold balanced portfolio of equity and fixed income in an effort to add more value to client portfolios by reducing risk and thus enhancing risk-adjusted returns. In essence, this defines what makes us different and better, along with our adherence to our code of conduct. So we are patient, waiting for opportunities to buy assets for our portfolios, and it may be a reason why newer clients may still have more cash equivalent assets on hand, because building a solid portfolio takes time. No need to rush in and buy expensive assets if they are going to get cheaper. Well, each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark All Country World Equity Index ETF and blend it with the Canadian Bond Index ETF to get a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned about 10.5%, the two-year annualized return has only returned about 3.25%, which highlights the volatility over the last couple of years. Even the return over the last 3 years is well below the 5-year average. Now, our focus is on reducing volatility in our portfolios in the short term in order to avoid big swings in return and capture more consistent long-term returns. As we look at a longer-term HIROC private client, the one-year total performance after fees is just a little under 9%, but behind the benchmark. But with about 25% in a money market fund, this portfolio is significantly less exposed to expensive risk assets like equities at the moment, which we believe are vulnerable to at least a 10% correction. But the longer-term 4.5-year performance is still well ahead of the benchmark, a sign that we have been successful in lowering short-term volatility, which does in fact enhance long-term returns. At HIROC, we focus on the difference between the absolute returns and risk-adjusted returns. The actual HIROC private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60-40 comparative benchmark. And graphically, you can see that the absolute return for the HIROC private client is higher and the risk taken is significantly lower. Again, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. And we remind everyone listening that historical returns are no guarantee of future returns, but at HIROC, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. Well, inflation is one of our key themes for 2017 as we try to assess the implications of easy central bank monetary policy on current global economic growth. Expectations of tax reform and infrastructure spending by the Trump administration raised the outlook for a scenario of increasing inflation in the U.S., but so far this year we have not seen this follow through. As for the Bank of Canada, last week we suggested that without an advance in the CPI to at least their 2% target across all of their core indicators, monetary policy and interest rates will likely remain stuck in place. In last week's interest rate decision, the Bank of Canada maintained their overnight target rate at 0.5%, citing that their core measures remained below 2% and the considerable uncertainty as they outlined in their April monetary policy report, which pointed towards their concern for rising protectionist policies and the potential impact of those. As all central banks have a mandate to maintain price stability, this year we're focusing on inflation data as a key to determine if and when interest rate policy may change. We will see the latest from the European Central Bank on June the 7th, and the U.S. Federal Reserve is expected to raise rates by 0.25% on June the 14th. That will be in spite of the continued below target rate of core inflation at the consumer level. Now, U.S. first quarter GDP growth was revised higher with an upward adjustment to consumer spending in March. April consumer spending has the second quarter GDP growth expectations pointing toward about a 3.8 annualized rate of growth at this particular moment. Today's data from the Conference Board showed a second consecutive slide in consumer confidence, and this is something that we believe needs to be watched closely as we are in the late stage of the U.S. economic cycle, and the 3 previous recessions have followed a peak and subsequent slide in consumer confidence. Expectations are for U.S. interest rates to go higher at a faster pace than most other developed economies. But as short-term bond yields rise, which is the gold line you see on your screen, and short-term interest rates, and longer-term 10 and 30 years, which are the green and purple lines, remain the same or decline, the yield curve becomes flatter. Historically, the flatter the yield curve, the more likely a recession is to follow. Now, the 2-year to 30-year yield differential has narrowed considerably since the U.S. election to its lowest level at close to 160 basis points or 1.6% from the widest point of over 200 basis points or 2%. And that is about a 20% narrowing of that particular spread. Now, we'll be watching this closely over the coming months. And remember, bond markets lead all other financial markets. So that's pretty important to us. Well, on the debt front, global debt levels, as I say each week, are growing at an approximate 5% per year, while the global economy is expected to grow at only about a 3% return per year. If interest rates rise, this does put increased pressure on the servicing of that debt. Canadian household debt is at record levels, and in fact, almost 3/4 of Canadian homeowners would have difficulty paying their mortgage every month if their payments increase by as little as 10%. And that's a new survey from Manulife. 14% of respondents to the survey said they wouldn't be able to withstand any increases in their monthly payments, while 38% of those polled said they could withstand a payment hike of between 1% and 5% before having difficulty. An additional 20% said they could stomach a hike of between 6% and 10% before feeling the pinch. Add it all up, and that means 72% of homeowners polled couldn't withstand a hike of just 10% from their current record lows. That is quite a significant situation for the Canadian economy. And of course, the Bank of Canada is well aware of this. Well, U.S. household debt has also jumped back to higher levels than it was in 2008. Emerging market countries have been building debt, and China tops that list. And on May 23rd, Moody's Investors Service cut its rating on China's debt for the first time since 1989, challenging the view that the nation's leadership will be able to rein in leverage while maintaining the pace of economic growth. Moody's cited the likelihood of a material rise in economy-wide debt and the burden that will place on the state's finances, while also changing the outlook to stable from negative. China's stock and bond markets have already been feeling it thus far this year. As for value in the equity markets, not a lot different. You may have been hearing or reading the headlines that have been telling us that first quarter earnings are showing the best year-over-year increase since 2011. As I've been mentioning, if you look closely at the first quarter of 2016, the starting point, it was pretty poor quarter. So in fact, the actual earnings per share increase for quarter one 2017 or the actual earnings per share were lower for the first quarter than they were for the third and fourth quarters of 2016. The 12-month forward-looking earnings per share, which incorporate all the good news that's currently built into share prices, expects another 10% or so increase. But the forward-looking price-to-earnings ratio is already an expensive 17.6 times, while the 10-year average is at 14 times. And as we all know, in time, prices do tend to revert back to their mean, which indicates that earnings will have to grow by a significant 20% more than currently expected 10% to bring that ratio back to its 10-year average. Either that or the S&P 500 will need to correct by about 20%, or perhaps some combination of both. And another of our metrics of value enterprise value to EBITDA also shows to be as expensive as they were at the time of the dot-com bubble. Stock prices have been outperforming economic growth, and high equity prices do equal high risk in owning that particular asset class. And as we have proven, you do not necessarily have to own a full weight of that asset class to achieve long-term reasonable risk-adjusted portfolio growth. So for the moment, we are continuing to avoid being fully invested in equity assets. We would rather buy them after a 10% decline in price rather than before that 10% decline in price. So we'll remain patient. And as we suggested last week, the key is the amount of liquidity in the system. The U.S. Federal Reserve began adding liquidity, that white line that you see on the screen, by purchasing securities in 2009 with what was called quantitative easing, and they did 3 rounds of that. They stopped this in 2014, but the liquidity is still in the system despite 2 interest rate increases. Now that is what continues to draw stock prices higher. When the Fed decides to reduce this liquidity, which they are in the process of doing, stocks will lose their driving force. The Fed wants to gradually take this bubble away. It is a delicate situation. Well, on the geopolitical front this week, where are we on the Trump agenda? Well, in an exclusive interview with Reuters last week, Senate Majority Leader Mitch McConnell said healthcare and taxes still top the Republican legislative agenda. McConnell said he has yet to hit upon a formula for repealing Obamacare and replacing it with a new healthcare program. Referring to behind-the-scenes work among Senate Republicans on a healthcare bill, McConnell said, "I don't know how we get to 50 votes at the moment, but that's the goal. Healthcare legislation must be passed by the Senate, and then the two chambers must work out the differences between their versions before it can go to Trump for his signature." Treasury Secretary Steve Mnuchin said last week that the Trump administration hopes to pass a plan to overhaul the U.S. tax system by the end of the year. Mnuchin stated clearly that we're not going to get that done by August, backing away from the original timeline the White House had set for tax reform. But other issues have been providing some distraction, and relations with Europe have gone a bit chilly. Protectionist issues, again, are at the center of concern. And German Chancellor Angela Merkel warned that Europe must start to plot its own course in an increasingly unreliable world order shaken by Trump and Brexit. Meanwhile, North Korea continues to flaunt its nuclear capability. So here at High Rock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with overvalued stock prices that are high because there is so much liquidity in the system. The economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth. We are not gamblers. Paul, anything to add today?
I don't really, Scott. I've been working on, continue to work on this home capital situation, and looking for a couple opportunities in there, but I ran into a slight roadblock on one idea I had, so I'm continuing to try and see if I'm right or wrong on it before we do anything. So that's really what I'm spending most of my time on right now.
All right. Now, one thing you mentioned to me just before we went on the call was the Fed Governor Brainard, who has suggested that if inflation does not pick up, and of course we've actually seen inflation, sort of the core inflation, slipping away in the U.S., that the Fed may have to review or revisit some of its potential for pushing for higher rates, and that seemed to slip very late into the day into the bond market. And as we always talk about, the bond market is going to lead other financial markets. Any comment?
Yeah. So just briefly, she gave a speech with prepared remarks and effectively said that, as you mentioned, that inflation seems to be taking a pause and ticking a little bit lower, which would signal to a central banker that perhaps they don't need to raise rates as aggressively as originally thought. So the bond market in the U.S. Treasury bonds have rallied, i.e. rates have gone lower a fair bit just on the back of that today. But actually, you know what is a good point, though, just in general, and we show this chart, you show it often, but two things, just anecdotally. Number one, the Fed's raised rates how many times? 3 times so far?
2.
Well, 2 one in December and one in March, correct?
Yeah.
I think.
Yep.
Yeah. And rates are out the curve. 10-year and 30-year bonds are lower in yield. So when people say, oh, rates are going up, don't want to own any government bonds, those are people that don't understand the yield curve. So there's been a very good rally or move to lower yields and higher prices in government bonds further out the curve, 10-year and 30-year. And in fact, that's where we have more of our exposure to government bonds or interest rates. So that's certainly one thing to note. And I think the second thing to note is most U.S. recessions start with the Fed raising short-term rates. And you can look at short-term rates being from overnight out to 2 years. And right now, I think what the 10 and 30-year part of the yield curve is telling us, because rates have gone lower in that part of the curve, is that the bond market actually thinks the Fed is making a policy error by raising rates prematurely here. So that's a very important note. And we continue with that view here at High Rock. So.
Yep. No, and that's very interesting, because we do often look at the other side of the U.S. economy, and we've talked a little bit about some of the signals that we've seen that give us caution. So it is interesting that some of the people at the U.S. Federal Reserve are seeing are becoming a little bit more cautious as well. Now, one other thing, because you bring up the yield curve, the flip side of the yield curve, and of course we can equate that to what's going on in Canada, but often I'll have clients ask me about whether they should fix their mortgages or fix their HELOCs into a longer term situation, and I have pretty much always suggested that it's probably best to keep it floating at this juncture, and given what we're seeing in the yield curve, perhaps that still holds true, right?
Yeah, I would agree with that for sure. I wouldn't be locking in anything as of yet or terming it out further. Not yet.
Yeah. Okay, great. So thanks for chiming in on that topic. So that's it for today. As always, we want to thank you for taking time out of your busy schedules to listen in. If you do have any questions or concerns, please definitely email us. We'll be back with our next update next Tuesday. But until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great week.